Hi there everyone and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it is entitled to your particular circumstances and you need to decide for yourself whether it's appropriate to you. Okay, so from a technical standpoint, not much has really changed since we spoke last week. Market is still tracking along near 73.60. 73.50. It's a bit of a magnet for the market at the moment. It can't quite really push up above 74 here, nor can it really break much below 73.50 either. So at this point, we're just really stuck whipping around sideways. As we can scroll out here, you can see that the uptrend line, forget about that one, the uptrend line, I'm probably drawing it more like this. This, I think, better represents the steepness of the trend currently. So it's nowhere near as steep as it was back here, okay? And I think that's just a sign of the times now. We were in recovery mode back here. We're now coming out of recovery mode and going back into more of a normal market. And this type of sideways to bullish behavior is very normal for our market, very normal. One thing just to be on high alert about, we do have a reversal pattern showing up on the chart here. It's called a head and shoulders. So your left shoulder, head, right shoulder. The fact that we haven't broken down through support yet, I don't think this pattern's going to play out. I actually still think we're a bit bullish here. I do kind of feel we're still going to run into Christmas and probably up near the all-time highs here. So yeah, all in all, guys, look, the market's sideways. I don't think we're breaking to the downside anytime soon. So at this point, sideways to eventually break up through 74.80 here and then we'll see what happens into the all-time high. So coming across to the US market, they have really outperformed us over the last 6 months. They actually have pushed up a bit higher where we're still tracking along sideways. So we haven't really joined in on the recent gains that they had through October, November. We've stuck really sideways and towards the bottom of our range where they're testing all-time highs. Okay, so at this point in time, this is the third touch of the all-time high. I think the fourth attempt is going to get us through. At this point in time, the futures are sitting pretty flat, still below 4,700, so I can't really see that happening tonight. There's some key news coming up later in the week with the Fed, and I'd dare say at this point the investors are waiting for that. But technically, look, the trend's still intact. It's still on a fairly steep sort of angle, and it's maintained that most of the way through, okay, except for through here where it was quite steep. Really, since September of 2020, it's stayed on the same steepness, unlike our market, where our market trend is shallowing out. Their market trend still looks very, very strong. So technicals are still very bullish medium to long term here, guys. We're just a bit stuck sideways in both markets for now. Okay, so first things first, the debt ceiling issues are now off the table. We saw over the weekend that now the Democrats have the power to vote. All they need is a majority vote to increase the debt ceiling, and they should have that vote this week. The fact that they've got the majority in both chambers now means that should just sail its way through. The positive, there's a couple of positives here. One, we should avoid, obviously, the debt ceiling issue altogether this week. Okay, they were predicting by tomorrow or by Thursday that the government was going to run out of money. Yeah, I don't think that's going to be an issue. I think they'll vote that through, obviously, before that all plays out. And the market won't be too phased about the debt ceiling now moving forward. This also sort of paints the way forward for the social agenda of the Democrats in the US as well. So we do expect a lot more government spending over there compared to what we're seeing locally. So locally, we'll see the budget handed down later in the week as well. And we expect the Australian government to turn the taps off. Okay, so that's in a sense actually not a positive thing for the markets, but if the economy can stand on its own 2 feet and see some growth without the government pumping money in, then I think that can be an underlying positive as well. Regardless, our market, look, I think with the driving factors out there at the moment, a lot of industrial spending around the world, miners will continue to push us higher. With immigration coming back next year, that's good for the banks and the real estate and the REITs. So all in all, I'm still bullish our market, but I'd be a lot more bullish the US market on the back of the fact their government's still spending and injecting money into their economy. The big thing for the week is really the Federal Reserve, and I think that's what's holding markets back and holding things, just making things a bit tame at the moment. Otherwise, I really think the US would have broken into all-time highs on the back of the debt ceiling news over the weekend. So at this point of time, the Feds, we're expecting them Thursday morning to taper the bond buying programs a lot quicker than what they have so far. Some people even suggested to double that. With the CPI reading coming in fairly well as expected, and when you drill down into the details of that CPI rating in the US, most of the inflation's coming from energy. Okay, so from fuel, from energy costs, that's where the majority of it's coming from at this point of time. So given that, most of the energy issues will probably get resolved over the next 12 months. Most of the inflation we're seeing is still actually transitory. It's just taking a lot longer to fix the supply side issues caused by COVID. So, look, I don't see interest rates going up as quickly as what a lot of other analysts are saying. Okay, so there's a lot of analysts predicting, and even looking at the bond market's predicting rates to go up next year. I still don't think that's going to happen. If it is, it's going to be very late of next year or even early the year after. So, we're talking more 2023 in my books rather than 2022 for a rate rise out of the US Fed. The RBA was very clear on what they said last week, and that was that rates aren't really going to go up anytime soon. They're pretty happy to sit on their hands and wait for wage growth. Okay, so at this point of time, look, I see this all as positive. Even with bonds tapering both here and offshore, the bond buying tapering, the central banks are still extremely accommodative. Okay, so they're not increasing rates yet. They're not even really talking about it. Okay, there's a few hawks out there, analysts out there spooking the market. You're going to get volatility around these Fed meetings. People are going to read too much into what they say sometimes. You're going to get these knee-jerk reactions. But as long as the uptrends on the markets hold, okay, this is a buy the dip market, guys. Okay, so it's all, so that's where we're at for now anyway, right? Things always change, but for now, that's where we're at. Last but not least, obviously we got Omicron, okay? That's simmering around in the background. I think that's affecting certain sectors more than others rather than affecting the whole market. Travel's obviously pulled back a little bit on the UK lockdowns. Locally, though, at this point of time, we're not really seeing any signs of us locking down again, okay? The difference could be we're going through our summer, Europe's going through their winter. These types of viruses, a lot more, transmissible through winter and cold weather, okay? So us coming into summertime, I can't see us going down into lockdown, not from the rhetoric we're seeing out there at the moment. But I think the UK lockdowns have spooked certain sectors a little bit. We're seeing the travel stocks come back off a little bit. Obviously, we don't know what we don't know with Omicron, so we're going to have to keep watching this space very, very carefully. There's a lot of news out there suggesting that the AstraZeneca vaccine, 2 doses aren't very effective against it. So the booster shots, the third shots from Moderna and Pfizer are going to become very, very important over the next few months, and we'll see how that all plays out. Last but not least, guys, once we get past this Fed on Thursday, we're really open for a Santa rally. As long as the Fed don't say anything they shouldn't, okay, then we should be cruising on up into that Christmas New Year period. It generally is a bullish period of time, okay? So I suspect the US market could pull back a little bit tomorrow into the Fed meeting. Our market could pull back a little bit tomorrow into the Fed meeting. But Thursday, Friday onwards, we should start kicking a bit higher into it. Once again, as long as the Fed don't become too hawkish and start talking about increasing rates next year. Okay. All right, so that's where we're at, really. We're just waiting for the Fed meeting now. We think muchness of sideways between now and then. But then, yeah, at some point between now and the new year, I could definitely see the XJ back up near 7,600 and the S&P 500 into an all-time high. Okay, that's where I'm at this point of time. All right, so that's it for this week. Thanks for listening in. Take care and bye for now.